So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we're going to answer the question, what is an IV crush? So an IV crush, or an implied volatility crush, happens when the market goes from a period or an event of unknown information to a period or an event of known information. Now, the best example of this is likely an earnings event that a company might go through on the corporate level. So before earnings are announced for a company, the market has a lot of uncertainty. Where is the company going to announce earnings? Did they make a profit? Are they growing revenues at the appropriate rate? Is there something that they haven't told us that they might tell us during this earnings event? And so as a result, we start to see implied volatility or expectation of a big move start to rise heading into that earnings event. Now, once the company actually announces earnings and all of the information is now known and public, even if the information is bad or even if the information is good, we start to see implied volatility contract or crush. And this is again because we have now crossed between an unknown event and a known event. This is why oftentimes we start to see stocks have a huge move after earnings, but implied volatility actually go down. And it's because even though the stock had a huge move and the company is now repriced based on earnings, the now future expectation is a lot more subdued because we now have gone through the earnings event. All the information or worries that we had before are now kind of behind us for the next 3 months. And we can now kind of maybe trade the stock within a tight or regular range. And so that's why we see implied volatility go down, because market participants now have this known event beyond them. Again, even if the news is really bad, the company missed earnings or had a bad quarter, the fact that the information is now known and public is more important sometimes than what the company actually did during that quarter. So I encourage you to actually look at charts and watch this actually happen. We have videos of this on Option Alpha that you can watch, and we have some live videos where you can see the actual implied volatility crush right after the earnings are announced. But I would encourage you to go back through time and just look at how implied volatility reacts after companies make corporate announcements. As always, hopefully this helps out. If you guys have any other questions, let me know. And until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.